Well, the emerging markets sell-off is continuing and all markets are really down at the moment, and I'm at ETX Capital and I'm joined by Adrian. I'm still trying to work out if this is a big deal or not. Earlier in the week I thought this was just going to be something which will last a day or two, but it seems to be persistent. In your eyes, is this a big deal? Should we be worried in the longer term for markets?
For the emerging country, yes, it could be a big deal, but there is no risk of contagion. Basically, of course, in the short term, every market are linked together, so this affects the classic market. But on the long term, I'm not sure there's going to be a risk of any contagion.
If this isn't such a big deal, why are we seeing not just emerging markets down, but also we're seeing pressure on the Footsie, on the Stock 600, and also on the S&P in the US, and also the strong Asian indices, they're also down. So that maybe doesn't really play into your idea that it's not such a big deal.
So, a few reasons why. The first one is the reason why the emerging market is going down is more local, so we can see the economic and political crisis in Turkey and in Ukraine. We've got as well in Argentina, the government that decided to devalue the peso. Secondly, we got people that have still in mind the crisis of 1990, where at that time the emerging country, the financial background was really weak. Now it's getting stronger and stronger. So there is a crisis, but then they can start again. We can get back from this crisis better than they used to be in 1990. And the last thing is, in Europe, unfortunately, the impact is a bit more. We can see the impact a bit more than in the US, just because we're just recovering from a bigger crisis as well. So we are still weak. So every single small crisis affects a bit more than in the US, and China is as well. It's really local as well.
But what sparked this mini sell-off, or this sell-off that we're seeing at the moment? I've heard different theories, even though it might just be as simple as that someone like BlackRock just moved their money out of emerging markets. In your eyes, what started this whole movement?
No, I think, of course, it's people that getting the money out to invest somewhere else, somewhere more safe, depending on what happened in the market. It's just now in nowadays it's really easy to move money from one asset to one other. Depending on what happened to one country and to one other, people just move the money out, put the money somewhere else. But in few times, as soon as they're gonna get better, they can do the same thing as well. So getting the money out and to put as well in the emerging market. So in the long term, I think we could be pretty confident as well. But of course, in the short term, we can see the sell-off continue for quite some time.
Okay, as always, when we come to ETX Capital, we take a quick look at the Footsie, and I'm joined by Ishak. Ishak, every time I come to ETX, you guys always say the Footsie's going up, but I can't believe you're going to tell me that now, that the Footsie's going up, because there's so much exposure to the emerging markets in the Footsie. So what's going to happen? Is it just downwards from here?
Oh, I'm thinking the Footsie is going to stay above the 6,500 level, even though we're touching around 655 at the moment, so quite close. I think the problem with the Footsie right now is that, as you said, there is a number of reasons for why we're going to test the downside, but I don't think it's going to fall below. I think we've got good support coming in at 6450 the last time I checked. One of the reasons why the Footsie 100 should remain range bound for the next few weeks, at least until mid-February this year, is because we still are seeing decent earnings coming out from a number of UK corporates, particularly the mining sector. We have decent numbers out from Anglo American this week. We also had from Antofagasta, and also at the same time from a couple of media companies such as ITV, and also from the likes of B-Sky B. The big problem that we're facing now is this emerging market exposure that we have. Some companies are doing better off the back of it. The likes of Diageo, SAB Miller, and Imperial Tobacco are seeing positive currency effects on the back of weaker currencies in the commodity in the emerging market space. But at the same time, companies that are hugely exposed to that, investors are now turning away from them and looking at other companies within the Footsie 100 to get better exposure to, on the worries that structural problems in the emerging market space is going to ultimately lead to a collapse of valuation for a number of companies. So it's a bit of a sticky situation. At the same time, we have to factor in the fact that the Federal Reserve is now, they're on course to taper. They continued to taper again with the decision overnight. I think they're going to continue tapering for the course of 2014 until QE, as we know, ceases to exist. That's going to have some downside pressure on the Footsie 100 going forward. And at the same time, a lot of the focus is now shifting towards the Bank of England's monetary policy when it comes to what we have to say about forward guidance. The market is still very much unsure as to where the BOE is going. We're not going to see any moves or adjustments to policy, but what we do need to know is how are they going to refresh certain thresholds, particularly the unemployment rate, as we saw a massive decline in the unemployment rate in the UK, up down below the 7% mark. And I think that's what the market is now looking for, a bit more guidance from the BOE.
Just in terms of this sell-off we're seeing in emerging markets, which is obviously impacting all markets at the moment.
Yep.
Just how long do you think it's going to last? So I was thinking at the beginning of the week that, okay, this is just going to be a minor blip. It's just going to, there's been some money moved somewhere from emerging markets. And it'll only be a temporary thing, but that pressure is remaining, and also it's carried on after the Fed tapering. So do you think this is something that's going to be a real theme for the next few weeks?
I think it's going to be a theme for the first quarter of this year, as asset allocators have to adjust themselves, reweight their positions, their portfolios in a way to be able to catch their certain positions in the right way, so they don't get affected by the burnout in the emerging market space. The problem is that the emerging market space is not only suffering from the fallout of the Fed starting to taper their asset purchases, but at the same time the slowing growth in China, which is now becoming a far more protracted than we previously thought. So that's something that we're going to have to deal with. And as long as we're having to factor in the idea that China's slowdown is accelerating, a lot of people in the market are going to be worried about how this is going to affect the emerging market. At the same time, we also have to remember that domestically, a lot of these countries have their own structural problems. The fact that their central banks are not doing enough to spur economic growth. At the same time, they've got a number of problems when it comes to public spending and government debt, which they are not able to get on top of. And I think all of those reasons combined leave investors extremely worried about the emerging market space in whole. However, having said that, I think one thing that investors are playing on at the moment is getting out of the emerging market space, going into developed market space, however not completely turning away from emerging markets and really waiting for the right opportunities to get back into that market and buying at a price when they feel it's cheap and offers enough value.